Yeah, so the big debate in the market is whether the traditional 60-40 multi-asset portfolio actually makes sense anymore. I wouldn't be too critical. I think bonds did a reasonable job of protecting portfolio drawdowns through the worst of this crisis. I mean, sovereign bonds are still one of the best performing asset classes year to date. But I think looking ahead again, with negative yields in Europe, with sub 1% yields on the 10-year in the US, it's difficult to see traditional safe haven assets like sovereign bonds actually deliver returns ahead of inflation. Now, that leaves a tricky dilemma in terms of buying more riskier assets like equities. And as you say, valuations aren't particularly cheap at the moment. But we do expect to see institutional investors actually increase their strategic holdings to equities. We've seen some of that already happen with the Norwegian pension fund and indeed in Canada. And that's something we're looking at the moment in our portfolios in terms of how can we deliver a decent level of a return for investors without taking on too much risk. And unfortunately, sovereign bond yields at the moment simply don't deliver on that.
Yeah, we both saw the 3-year zero coupon Italian stuff earlier this week. That was challenging for any investor. Brian, quick word on something else that you've got me thinking about as well, and that is your gravitation towards cyclicality over growth on valuation issues. And I totally understand where you're coming from as well. But which of those cyclical sectors that you're looking at have actually an added structural problem that they're never going to come back again? I.e., there's a trap there from some of these sectors' cyclicality that they're actually not cyclical and they've become structural bear markets.
So obviously what you need to avoid is a value trap. Questions still remain about the travel and tourism sector in particular. One of the reasons we haven't added industrials to our portfolios because we still think that could weigh on the sector. So we take a broader view, and when we look at different styles, the studies we've done and others have done show that value as an investment style is at a 45-year low versus growth. So while there are plenty of challenges facing some of these cyclical companies, we think the value dispersion now between growth and value has just got too extreme. And indeed, when we look at earnings next year, analyst forecasts are for those cyclical areas such as consumer discretionary, energy, industrials to recover the most. And given the low valuations there, we think adding some value and cyclicality to portfolios is the right and prudent move at this stage to position portfolios for economies open up when a vaccine is delivered.